Hi everyone, it's Grace. Welcome back to my channel. In last week's video, we talked about how inflation affects our lives. I mean, it's used a lot differently, but I feel like it's not really fully understood. So if you want to know how inflation affects us each individually, make sure to check out the video on the top here. So in today's video, we're going to talk about what will happen with the first Fed rate hike that's coming in March and how the stock market and the housing market react to it. As usual, before we begin, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. Powell actually alluded on March the 2nd meeting that the Fed rate hike schedule might be something like this.
So it's a little bit like the rate hikes that took place in the first part of this century. Not the rate hikes that took place after the global financial crisis were much slower. They were every other meeting. But the cycle before that, the rate hikes at consecutive meetings. So what you feel is these are fairly small rate increases, 1/4 percentage point every 7 weeks. And we haven't, by the way, we haven't made any decisions after this meeting.
It will start with 25 basis points, and the first one will start on March the 15th and 16th meeting. So probably in the interval of every 7 weeks. So in this year, it's approximately 6 to 7 rate hikes. The decision hasn't been made yet, but the illusion is that it's similar to this. And it will be raised all the way to 2% to 2.5%.
We talk about getting to neutral, which is a neutral rate, which would be somewhere between 2 and 2.5%. It may well be that we need to go higher than that. We just don't know.
So this is the possible Fed rate hike schedule that you should pay attention to for your investment and financial decisions this year. I mean, it's still pretty abstract, so let's just keep it as simple as possible to understand. I think referencing historical data actually helps a lot to understand where we stand right now and what to expect in the future. So let's take a look. The first thing is that recession almost always aligns with sharp rate decrease after the rate hike is finished. Like here, you can see that the gray bars represent the recessions, and there are the Fed rate hike periods and the rate decrease periods. This is an important graphic, and I've used a lot in my past videos, but I'd also find the word recession a little bit generic. Doesn't mean the recession of the stock market, the housing market, or both, or something else. I mean, let's get specific and look at them individually. For the purpose of today's discussion, I will only talk about the stock market and the housing market. But if you're interested in crypto or other types of assets, go ahead and leave a comment down below and let me know. For the stock market, I'll be using S&P 500 as a reference to the general movement of the stocks. Please know that individual stocks may behave differently. So before 1990, there was almost no reaction of the stock market to the Fed rate hike, which is pretty interesting. And then after 1990, there's almost always an immediate crash with rate decrease after a period of rate hike and a sudden ballooning of the Fed's balance sheet. For the 2000 dot-com crash, the Fed's balance sheet size was relatively small compared to today, of course. But a rate decrease after the rate hike was enough to cause a crash in the stock market. I associate the rate decrease with rate hike because they're always bundled together as a cycle. If the Fed starts with 25 basis points with an interval of 7 weeks throughout this year, the stock market will have a lot of ups and downs, given that the pattern already started. Now, this is only for this year because the Fed also needs to look at the market reaction to determine the future policy. So generally, the Fed rate hike pattern makes the stock market very choppy. The growth of the stock market pretty much aligns with the growth of the Fed's balance sheet. So if the Fed does decide to shrink the balance sheet aggressively, the stock market will tank. So the stock market is very, very reactive and positively related to the Fed's balance sheet size. That I can be confident just from this graphic alone. So for those of you who holds investment portfolio in the stock market, the Fed is your captain. So now let's talk about the housing market, and I'll be using Miami as an example. Now, Miami is a highly volatile market, so it might be different from your local situation, but the peak point and the bottom point is pretty much the same in terms of the timeline. Similar to the stock market, the housing market also had no reaction prior to 1990. One interesting observation is that the housing market is not always aligned with recession. During the 2000 dot-com crash, for example, the housing market in Miami did not react to the Fed rate hike or rate decrease. Despite all the rate movements, the price kept going. During the very short COVID recession at the beginning of 2020, the housing market also didn't crash or react to the Fed rate hike cycle. In fact, the only time that we ever had a housing crisis is the 2008 financial crisis, which lasted from the first quarter of 2008 to the fourth quarter of 2011. The rate hike decrease cycle between 1994 and 2000 is separated into two stages. Each rate hike or decrease lasted about a year and a half. Then there's a stage of flattening rate in between, which created a period of steady growth in the price trend. The rate hike decrease cycle between 2003 to 2011 is finished in one set. Each rate hike decrease lasted about 2 years. So this cycle was more drastic than the one prior to the dot-com crash. Besides the drastic rate cycle, another important trigger of the crisis was the extremely low Fed funds rate, which made the mortgage rate very affordable. And the 2015 to 2020 rate hike decrease cycle seems to be moderate again. It took almost 4 years to hike a total of 7.5%. So the cycle was even more moderate than the period before the dot-com crash. So far, it does seem that the rate hike didn't stop the housing price from growing, because we can clearly see that the rate hike before 2008 and 2020 were accompanied by price growth. The housing price is also reflected in the size of the Fed's balance sheet size, even though it's not strictly directly related. Now, we pretty much know that hiking rates moderately by a total range of 2.5 to 5% in a period of 1 year, a year and a half, with just one cycle could be safe. But continuously hiking rates without a flattening rate period could be dangerous, like the one we saw in 2008. Now, we know that the Fed will probably raise the rate to 2.5% by the end of this year, but we don't know whether it will continue or take a break and then continue again. We also don't know if the Fed will increase the rate to above 10% over a shorter period or spread it out over a longer period, and when it will start to shrink the balance sheet size, by what increments and at what intervals. So these are all the factors that we need to look at as we go. And then let's compare the only housing crash recorded in 2008 and now. Is it a good reference? I mean, we shouldn't compare 2008 and now because unlike this prime mortgage lending back then, lenders are extremely cautious about lending mortgage now. But we can still compare in the sense that there are more institutional investors and there are more loans resting in the properties invested by them. When the housing market crashes, for the properties that hold more loan volume than the market price, institutional investors may decide to offload some of them. They do so either to stay liquid or keep the bonds grading up to standard. Otherwise, these companies will run into default risk, their bonds will be downgraded, and it's almost impossible to borrow money in the future. These loans could be in the form of corporate bonds, notes, or some other types of bonded bonds instead of mortgage. So here's the thing, each business cycle is unique because of technological innovation and development. So if any major factor comes up, we shouldn't ignore them. I do see the risk factor that a lot of corporate loans are tied in housing because many institutional investors purchase properties, so they hold a lot of inventory. They will probably offload inventory if the Fed decides to take an unusual and aggressive action in a rate cycle and balance sheet reduction. When institutional investors decide to offload some of the inventories, they may sell them at a discount to first-time home buyers, for instance, instead of keeping and renting the properties. I'll be providing the two graphics that I discussed today in a link down below so you can take a look at it by yourself. So this is today's video about what I think the Fed rate hike schedule will look like and how they impact the stock market and the housing market. I know that there's a lot of technical stuff, but it's the simplest way to understand how a macro policy affects a local market. In the next video, I'll be updating the Florida housing market this year and provide some tips for those of you who are interested. As always, thank you very much for watching, and I'll see you on the next one.